In 2025, the economy tracked along a better path. GDP growth accelerated, but it was still below trend. Inflation slowed to be back in the target band, and that was enough for the central bank to cut interest rates 3 times over the year. In 2026, the outlook has changed quite a bit. We expect economic growth to improve a little bit more to be closer but still below trend. However, inflation has been stubbornly high, breaching the ceiling of the target band once more. In this context, we are no longer looking for rate cuts, but rather looking for rate increases from next year onwards. Certainly, the likely directional change for interest rates will be a key turning point for investor strategy. We say that because interest rates set the price of money over time. It also sets the balance between those who borrow and those who lend money. The prospect of no more rate cuts and potentially higher interest rates will tilt the balance away from borrowers and back to lenders, away from real estate equity and in favor of real estate credit. Meanwhile, we are still seeing divergent returns across different locations and different real estate sectors. In other words, there's still a lot of alpha returns for investors just by backing the right market and the right sector. We can illustrate this very clearly with the residential market. Looking at this chart, we can see the recent trend in housing prices across major capital cities. In 2025, we've seen big price gains for Brisbane, Adelaide and Perth, with Sydney trailing and Melbourne struggling through a mild downturn. In 2026, we do expect the performance gap to narrow over the course of the year, but the ranking from top to bottom will most likely persist for most of the year. Meanwhile, we're expecting a similar degree of dispersion in commercial markets as well, with living sectors in the lead, retail and industrial not far behind, with office clearly trailing this cycle. Altogether, we are seeing good opportunities across real estate markets in 2026. The move from falling to rising rates will shift the momentum from equity to credit. There's still a wide performance gap between sectors, so finding the right strategy is vitally important. We continue to prefer residential over commercial, given the fundamental shortage of housing we have here. You can find out more about these themes by reading our report online or by talking to our capital team. This has been Bruce Wan from MaxCap Group.